There is a profound, almost suffocating psychological whiplash taking hold of the global economy right now. We are entering the spring of 2026, and a very dangerous narrative has just collided with a very cold mathematical reality. For the past 18 months, the financial media, the stockbrokers, and the politicians have been selling you a comforting story. They told you to just hold on a little bit longer. They told you that the central banks were about to pivot, that interest rates were going to plummet back to zero, that inflation was conquered, and that the era of free, easy money was about to resume. Millions of hardworking people believed this story. They stretched their budgets, they kept their high-interest credit card debt floating, and they bought wildly overpriced houses and stocks, assuming that a sudden wave of cheap credit was going to wash over the economy and save them. But over the last few weeks, the architecture of that illusion has begun to crack. You look at the cost of your groceries, the price of your energy bill, and the relentless rise in your insurance premiums, and you realize that the narrative of conquered inflation was a lie. You look at the central banks, and you see that they are paralyzed. They raised interest rates aggressively to fight inflation. Now, economies are slowing, growth is weakening, the pressure to cut rates is building. But inflation doesn't disappear overnight. If they drop rates now to save the stock market, the cost of living will explode into the stratosphere. They are caught in a trap, and because they are caught in a trap, you, the average worker, the saver, the consumer, are becoming the collateral damage. I have spent the better part of 8 decades analyzing the machinery of global capitalism. I have seen the inflation spirals of the 1970s, the euphoric delusions of the 1999 dot-com bubble, and the devastating credit collapse of 2008. The faces change, the technology changes, the underlying manipulation remains exactly the same. What we are witnessing in March of 2026 is a monumental reality check. The market is suddenly waking up to the fact that the rules of the last 15 years are dead and buried. If you continue to manage your personal finances based on the assumption that a magical bailout is coming, you are walking blindfolded toward a financial cliff. Today, we are going to have a brutal, unapologetic conversation about the reality of your money. I am going to tear down the mirage of the modern economy. I will expose the 5 specific financial illusions that are bursting right now, the lies that are engineering the poverty of the middle class. And then, I'm going to give you the exact unyielding mathematical protocol that the truly wealthy are using to shield their fortunes from this volatility, build impenetrable fortresses of liquidity, and systematically acquire the productive assets of the world while everyone else is panicking. This will be a long, dense, and demanding masterclass. It requires you to abandon your ego, silence your emotions, and look at your balance sheet with cold, clinical objectivity. But if you have the discipline to stay with me until the very end, and the courage to execute the protocol I am about to share, you will completely rewrite your financial destiny and build an empire that cannot be confiscated. Let us begin by dissecting the current environment. We must expose the 5 illusions of 2026. The first illusion is the mirage of the rate cut rescue. The entire middle-class strategy for the last 2 years has been based on procrastination. People are carrying variable rate mortgages, massive auto loans, and staggering credit card balances because they are convinced that interest rates are going to drastically fall. They believe that if they can just survive for a few more months, the central banks will slash rates, their monthly payments will drop, and their houses will suddenly skyrocket in value. This is a fundamental misunderstanding of macroeconomic history. When inflation has been structurally embedded into the supply chain, into energy grids, and into wages, it does not simply vanish because a central banker gives a speech. We are seeing right now that inflation is sticky. The cost of services, the cost of shelter, and the cost of raw materials are refusing to surrender. Therefore, the cost of borrowing money must remain elevated. If you are sitting on high-interest consumer debt, waiting for the Federal Reserve or the Bank of England to save you, you are committing mathematical suicide. You are paying the bank a premium to look wealthy while ensuring that you remain permanently poor. You must realize that nobody is coming to rescue your balance sheet. You are the only one who can save yourself. And the first step to salvation is accepting that the era of free money is definitively over. The second illusion is the blind worship of extreme overvaluation in the stock market. The most dangerous moment in investing isn't a crash, it's confidence. Right now, despite the economic headwinds, we see retail investors pouring their life savings into a handful of technology companies at valuations that defy all historical logic. They are driven by the absolute certainty that artificial intelligence will create infinite profits overnight, and that the market is simply going to continue to go up forever. They are suffering from FOMO, the fear of missing out. People buying because they can't stand watching others make money. You must look at the cold, hard mathematics of the market today. The S&P 500 is trading at valuations that have only been exceeded twice in history, once during the dot-com bubble, once during the 2021 peak. Both times were followed by significant pain for investors who bought at those levels. The current price-to-earnings ratio of the S&P 500 sits around 27 to 28 times earnings. The historical average is closer to 16. That means stocks are roughly 70% more expensive than their long-term average. But what makes 2026 uniquely dangerous is the unprecedented level of market concentration. Market concentration has reached dangerous levels. The top 10 stocks in the S&P 500 now represent nearly 40% of the entire index. This is unprecedented. When you buy an S&P 500 index fund today, you're not getting diversification. You're making a massive bet on a handful of technology companies. If those companies stumble, the entire market stumbles. And many of these companies are trading at 50, 60, even 80 times earnings. When you buy a stock trading at 30 times earnings, you're paying for decades of growth up front. If that growth doesn't materialize exactly as expected, you lose money even if the company does well. I want to buy wonderful companies when they're priced like average companies. That happens during corrections, during recessions, during periods of market panic. Buying wildly overvalued assets because the price went up yesterday is not investing. It is speculation, and speculation usually ends badly for the speculators. The third illusion is the hoarding of melting ice, otherwise known as saving fiat currency. The financial industry loves to sell you the illusion of the high-yield savings account. They proudly offer you a 4 or 5% return on your money, and you feel brilliant for taking advantage of it. The average American has approximately $65,000 in savings. In the United Kingdom, the average household has about £17,000 set aside. Most of this money sits in traditional savings accounts, earning somewhere between 4 and 5% interest. That sounds reasonable until you understand what's really going on. Inflation over the past 4 years has cumulatively exceeded 20% in both America and Britain. That means if you had $100,000 in 2020, the purchasing power of that money has dropped to approximately $80,000 in real terms. You didn't spend it, you didn't invest it badly. You just let it sit there being responsible, and you lost $20,000. The US dollar has lost over 96% of its purchasing power since the Federal Reserve was created in 1913. The British pound has followed a similar trajectory. When a central bank prints trillions of units of currency, they do not create new wealth. They simply dilute the purchasing power of every single unit of currency that already exists. It is the inescapable physics of supply and demand. If your bank pays you a 5% yield, and the real rate of inflation is rising faster than that yield, your safe investment is generating a guaranteed negative real return. You are paying the bank a fee every single year for the privilege of holding your money while it evaporates. Cash is not an asset. Cash is a melting ice cube. The fourth illusion is the ignorance of institutional panic. While the average retail investor is blindly buying an overvalued stock market, the most powerful, informed, and systemic financial institutions in the world are executing a completely different strategy. They are quietly engaging in a massive flight to hard assets. Central banks around the world purchased over 1,100 tons of gold in 2023. That's the second highest annual total on record, and 2024 is tracking similarly. China's central bank has been buying gold for 18 consecutive months.
Poland, India, Turkey, and Singapore are all accumulating. Why are the very institutions that create money out of thin air accumulating physical gold at a rate we haven't seen in decades? Because central bankers understand the mathematical impossibility of repaying global sovereign debt honestly. The United States national debt exceeds $34 trillion. UK government debt surpasses $2.7 trillion. European nations carry similarly staggering burdens. Central bankers see these numbers every day. They understand the mathematical impossibility of repaying these debts honestly. When debt becomes unmanageable, governments have historically done one of two things: default explicitly or inflate their way out. Neither option is good for holders of that currency. Gold protects against both scenarios. They hold gold because it's the only reserve asset that's not someone else's liability. Dollars are an American liability. Euros are a European liability. Pounds are a British liability. Gold is just gold. When the people who manage currencies are buying gold, you should pay attention. The geopolitical fragmentation of the financial system is accelerating, and the era of unquestioned dollar dominance is facing extreme pressure. If you are ignoring the actions of the central banks, you are ignoring the tectonic plates shifting beneath your feet. The fifth illusion is the false promise of complex financial products. Wall Street is very good at creating products that sound like solutions: enhanced income, buffered protection, participating upside with limited downside. In times of economic uncertainty, the middle class becomes desperate for security and yield, and the financial industry preys on that desperation. They sell complex products you can't explain in plain language: options trading, leveraged ETFs, structured notes, anything that comes with a glossy brochure, a clever name, and a payoff diagram that looks like a carnival game. A simple rule has served me well: if you can't explain how something makes money, you're not investing, you're trusting. And trust is not a strategy. Complexity increases the chance you'll be surprised, and surprises are what you cannot afford. Furthermore, these complex products often hide devastating fees. If you have $500,000 and pay 1% annually, that's $5,000 a year leaving your account. The real cost isn't just the fee, it's the growth you will never earn on the money that left. Over 15 years, those differences can become enormous. You do not need to pay a hedge fund manager millions of dollars to manage your money. You do not need a financial product with a 50-page prospectus. Complexity is the enemy of execution. We have shattered the illusions. The comforting narratives have evaporated. You are now standing in the desert of economic reality. It is stark, it is unforgiving, but it is real. And because it is real, it can be navigated. If you want to survive the 2026 reality check, you must stop operating like a frantic, emotional consumer, and you must start operating like a cold, rational, heavily armed financial institution. You must adopt the architecture of accumulation. This is the exact step-by-step protocol to build a fortress that cannot be breached by inflation, market crashes, or currency devaluation. Protocol 1. The eradication of destructive leverage. You cannot build a skyscraper on the foundation of quicksand, and high-interest consumer debt is the deepest quicksand in the global economy. I'm talking about high-interest debt: credit cards, personal loans, car financing at ridiculous rates, payday loans, buy now, pay later schemes. These products are designed by very smart people to extract maximum money from your pocket while making you feel like you're getting a good deal. The average credit card interest rate in America right now is over 20%. In the UK, it's between 18 and 25%. The stock market has historically returned around 10% annually over the long term. If you're paying 20% on debt while investing at 10% returns, you're losing money. Every pound you put toward investments while carrying credit card debt is a pound that would work twice as hard paying off that debt instead. You cannot out-invest high-interest debt. Don't even try. Eliminate it first, then accelerate your investing. You must attack this debt with unyielding fury. Sell the car, downsize the house, cancel every subscription that does not literally keep you alive. You must reclaim your monthly cash flow from the banking sector. The wealthy do not pay interest on consumer goods. They use debt exclusively as a tool of leverage to acquire cash-flowing, productive assets. Until your consumer debt is absolute zero, you are entirely vulnerable. Protocol 2. The construction of the liquidity moat. Once your destructive debt is eradicated, you cannot immediately throw all your money into the stock market, especially a market this overvalued. You must build an impenetrable wall between your family and the chaos of the economy. You must maintain strategic liquidity for opportunities and emergencies. I always keep cash available even though I know it loses purchasing power over time. Not because I love holding cash, because cash gives you options when others have none. In every market downturn, the best buying opportunities appear. Great businesses go on sale. Assets that were expensive become affordable. But you can only take advantage if you have available capital. I recommend maintaining at least 6 months of essential expenses in highly liquid form, not invested, not tied up in assets that could take months to sell, available immediately. This isn't money you're investing, it's insurance. It's buying power for emergencies and opportunities. It's what allows you to stay calm when everyone else is panicking. When the S&P 500 crashes by 30 or 40%, and it will, you do not panic. You do not check your portfolio. You do not sell your world-class businesses at a devastating loss just to pay for groceries. You live comfortably out of your liquidity moat, entirely detached from the panic of the masses. Yes, this cash will lose some purchasing power to inflation. That's the cost of security and optionality. It's worth paying. Protocol 3. The aggressive accumulation of the gap. Wealth is created in the margins. The speed at which you reach financial sovereignty is determined by one metric and one metric only: the gap. You must spend less than you earn by a significant margin. This sounds almost insultingly simple, but let me show you why it's the foundation everything else depends on. The average American household earning $70,000 annually saves approximately 3 to 4% of their income. That's about $2,000 a year. After accounting for inflation, their savings are essentially flat or negative in real terms. They're on a treadmill going nowhere. Wealthy households operate completely differently. They maintain savings rates of 20, 30, even 50% of their income, regardless of how much they earn. The gap between income and spending isn't something they think about occasionally, it's engineered into their lifestyle permanently.
I still live in the same house I bought in 1958 for $31,500, the same house 67 years later. I could afford any mansion in the world, private islands, fleets of cars, but I don't want those things. And here's what most people miss. The money I didn't spend on mansions got invested and compounded for decades. Every dollar you spend is a dollar that can't work for you. Every purchase trades present consumption for future wealth. Find ways to increase that gap by at least 10% immediately. Cut subscriptions you don't use. Reduce housing or transportation costs if possible. Every pound or dollar you free up becomes fuel for protection and growth. The first $100,000 is the hardest money you will ever make. Get there as fast as you can. Then let compounding take over. Protocol 4. The systematic execution of ownership. With your debts destroyed, your fortress built, and your gap expanding relentlessly, you must transition from a consumer of goods to an owner of production. The second component determines whether your savings survive inflation. You must own assets that produce real returns above inflation. Real assets are ownership stakes in productive enterprises. When you own shares in a company, you own a piece of a business with employees working every day to create value. You own equipment, inventory, intellectual property, customer relationships. These real assets tend to hold their value and grow even when currencies decline. For most people, the simplest way to own productive assets is through low-cost index funds that track broad market indices. You don't need to pick individual stocks. You don't need to follow markets obsessively. You simply need to own pieces of many businesses and hold them through all conditions. Choose low-cost index funds that own broad baskets of productive businesses, an S&P 500 fund, a total stock market fund, or a global equity fund.
Keep it simple. And you must automate this entire process. You must automate everything and remove yourself from the decision-making process. Human beings are terrible at making consistent financial decisions. We're emotional, we're easily influenced, we get tired and distracted. We intend to do the right thing and then don't follow through. Every study of investor behavior shows the same pattern. People buy high and sell low. They chase performance. They panic during downturns. They get greedy during bull runs. Set up automatic transfers so money moves to investments immediately after every paycheck. Remove yourself from the decision. Let the system do what you designed it to do. The wealthy don't have superhuman discipline. They have systems that make discipline unnecessary. The money moves before they can talk themselves out of it. The investments happen before emotions can interfere. Protocol 5. The cultivation of the intellectual moat. The final, unassailable pillar of the architecture of accumulation is the one asset that no government can tax, no central bank can inflate away, and no economic collapse can steal from you. It is your own human capital. It is your mind. I read every single day for hours. This isn't casual reading. This is 5 to 6 hours of focused reading daily. Annual reports, financial statements, newspapers, books, anything that expands my understanding of how the world works. When I started my career, I would read between 600 and 1,000 pages every single day. This habit compounds like interest. Every day, I go to bed a little smarter than when I woke up. Over decades, that daily improvement becomes an enormous advantage. In 2026, the global marketplace is a ruthless, highly efficient calculating machine. The market doesn't pay you based on how hard you work. It pays you based on how much value you create and how replaceable you are. If anyone can do your job with minimal training, you will always be paid near the minimum. If you have rare, valuable skills that companies desperately need, you can command almost any salary you want. You must build an intellectual moat around yourself. You must become deeply, painfully specialized in solving complex, expensive human problems. Increase your income through skills that the market values highly. Identify one skill that could significantly increase your market value and commit to developing it over the next 6 to 12 months. Not 5 skills, 1. Focus creates expertise, and expertise commands premium pay. You can develop a high-value skill for a few hundred to a few thousand hours. The return on that investment is potentially hundreds of thousands of dollars over your career. This is the highest return investment available to most young people. Not stocks, not real estate, your own skills and earning ability. I've always said the best investment you can make is in yourself. The transition from a vulnerable, highly taxed earner to an untouchable, financially sovereign owner is not a magical event. It does not happen because you picked the right cryptocurrency or timed the market bottom perfectly. It is the result of thousands of small, boring, highly disciplined choices made consistently over a long period of time. It is packing your lunch instead of buying it. It is driving the old, paid-off car for 5 more years. It is setting up the automated transfer into the S&P 500 index fund and having the stoic fortitude to never, ever turn it off, regardless of the chaos in the world. It is the courage to look completely average today so that you can be absolutely extraordinary tomorrow. We are standing at the precipice of a monumental shift in the global economy. The era of easy money, cheap leverage, and blind, passive consumption is coming to a painful mathematical end. The people who continue to operate under the old rules, the people who continue to chase the illusions, will find themselves working harder and harder for a currency that buys them less and less. They will be trapped in the hamster wheel of the plastic lifestyle, forever servicing the debts of their past. But you do not have to be one of them. You now possess the blueprint. You know the illusions to avoid, and you know the protocols to execute. Your financial future is entirely in your own hands. The government is not going to save you. Your employer is not going to save you. The central banks are not going to save you. You must become your own savior.
You must build your own empire. Audit your expenses tonight. Eradicate your destructive debt tomorrow. Build your liquidity fortress. Buy the productive assets of the world. Ignore the macroeconomic noise. Ignore the panic of the masses, and let the absolute, unrelenting mathematics of compound interest perform its magic. The reality check of 2026 is here, but armed with the truth, it does not have to be a tragedy. It can be your decade of absolute financial liberation. Subscribe to this channel. We are going to continue navigating these turbulent economic waters together. We are going to continue exposing the illusions and focusing entirely on the cold, rational mechanics of wealth creation. We are building a community of patient, disciplined owners who refuse to be victims of the system. The storm is already here. It is time to stop complaining about the rain, and it is time to build your fortress. Let's get to work.